Good afternoon, everyone. Welcome to today's very specially curated session with Endowus and UBS. We're so happy to see so many faces after 2 years. So thank you very much for taking the trip down to the wonderful office that we have at UBS. My name is Jamie. I will be the head of editorial and content at Endowus. And happy to see all of you, not just in person, but also those who are live streaming. We have that online as well, so please let me address all of you and welcome you as well to this online session that we have as well here. We just want to talk today about a very important subject that we have, investing in the future of China and in emerging markets. Of course, at this time, the markets have been rather volatile, and we've been very pleased to have two very well-regarded top speakers to be able to speak with all of you today. There will be mics roving through later at the session. Please feel free to ask questions, especially as you're all in person. Please don't be shy. And as well for the online audience, please share your questions with us, continue to stay engaged with us. Before we dive into the topic, I think we need to sketch out the investment backdrop that we have today. We have more than a decade of quantitative easing, and today we're in a more aggressive rates normalization, which the two guests will be better placed to talk about. But this also comes amid sharply rising inflation, and of course the quantitative tightening is now on the agenda. Rates normalization also comes in the third year of the COVID-19 pandemic. It's taken more than 6 million lives, took jobs, but it has also disrupted supply chains today, and that has contributed to inflation. This seems to be something, of course, that we are all concerned about. With the war that has emerged in February, that has also contributed to the inflationary pressures that we're seeing today. And I wanted to sketch that out because over in China as well, you're working with that investing backdrop. But there are also specific issues to do with the regulatory clampdown, for example, on the tech players that we're seeing today. That continues. And given all this cocktail of factors that we have today in today's markets, perhaps many of you may have these burning questions on what shall we do? You know, how should we think about the markets, not just the global markets, but specifically in China, which is an economic giant. It's just not something that we can ignore, but how should you be positioning yourselves for this? With that, let me bring you to introducing our two well-respected speakers with years of experience in watching the market through the cycles. Let me first, of course, introduce Kelvin Tay. Kelvin is no stranger to many of us in Singapore. He's the regional CIO of UBS Wealth Management here in Asia. Of course, a regular contributor to top media publications that we've seen, regular host. So you'll be in very good hands as he goes through what's happening in the markets. Let me, of course, also introduce at the same time Samuel Rhee, our chairman of Endowus. Sam, of course, has more than 27 years of experience. He was formerly the CEO of Morgan Stanley Investment Management in Asia. So you are in very good hands in both of these gentlemen. I will now let Sam to go through some of the points that he has in his mind. Take it away, Sam.
Okay, thank you, Jamie, and thank you, everyone. It's really great to be here in person to see you all. And thanks for joining us virtually for everybody in the virtual audience. So I'm going to start off very briefly to introduce the company Endowus, since Veronica introduced UBS Next and the team so well. Endowus is really about helping everybody invest better so they can live easier today and better tomorrow. You might recognize some of these faces. We've updated the slides to the latest On the Money campaign, which is real people talking about real money issues and how Endowus is helping them achieve better outcomes. There's a lot of great content there. You're going to start seeing it in the MRTs and stuff, but online at the Endowus Insights webpage as well, so please check that out. We are the only digital wealth platform for private wealth and public pension. We're the leading Asian fee-only wealth platform. and the first digital advisor for all your money. So cash savings, CPF savings, SRS savings. You can do that all seamlessly on a single platform for the first time here in Singapore. We have great investors, UBS first and foremost among them, but also in the seats we have Singtel and many other great investors, including the Economic Development Board of Singapore, who their global investment arm, EDBI, has invested in us because they believe in the future of Endowus as the leading wealth platform here in Singapore and across the region. Why our clients choose us? The company was really set up, and Greg, my partner in crime, co-founder and CEO, is here with me. But the business was really begun because we felt the pain of trying to invest our own money. And so we focus on the three major pillars of success when you're investing: advice, access, and cost. If I just touch upon the backdrop upon which we have decided to hold this webinar to address, especially China and emerging markets, but maybe as a backdrop, I can talk about more global markets and macro environment. Obviously, front and center, there's a lot of macro and geopolitical headlines that are dominating the newspapers and our mind space. And obviously, the Fed, inflation, stagflation, concerns about growth now is top of mind. And China in emerging markets is something that has been less talked about in recent weeks and months, but we still feel is such an important part of the future. And so, we're so happy to have Kelvin here with us so that we can really extrapolate on, what drives China, what are the things that are driving, the future opportunity as investors in China. And as in turn, China is the epicenter of the emerging market space. So we do want to touch on emerging markets as well. If I just have a quick look back of the last quarter, it was a truly unprecedented and very rare quarter where both equities and fixed income was actually down. It's only happened a few times in history, and it was actually one of the worst quarters in the history of financial markets. And one of the really standout characteristics, if we look at the factors that drove some of that underperformance, was really, I think, the massive hit that growth stocks took. And if you look at the relative performance of value, it's actually held up really well, considering where markets are today. So I think there is something that's going on that is macro-driven, and so we'll delve into that today as well. Fixed income markets, which is normally a safe haven when especially equity markets come down double digits, as it has done. But fixed income actually had the worst correction in 30 years. So again, truly unprecedented. And you can see in the charts, this chart includes the whole period of the tech bubble bursting in 1999-2000. That's the first big dip in the blue line, which is the global aggregate bond index. And then again, the GFC, global financial crisis, is the second a major dip. And then several dips since then. It's been a volatile market, but this is truly unprecedented in the scale in which the correction has occurred in such a short space of time. And the biggest driver of that, obviously, is the unprecedented backup in yield that we've seen in the fixed income market, with not only 10 years jumping from just barely above 1% to close to 3% now. It just briefly crossed 3% just yesterday, I think. And even on the short end, 2 years, which is driven by the Fed's short policy rates, is spiked up even higher from below 1% to close to 3% as well. And that's been driving markets tremendously. And despite a lot of people talking up commodities because of their recent rally, it is important to look at that space right now because it's topical, because it has done well. But you have to look at the long-term picture of what commodities actually is. And while it is seen as a safe haven, asset class, less correlated, it's also an opportunistic trade because the Ukraine war has disrupted supply somewhat. But if you look at the really long-term chart of commodities, it's actually a very volatile and very cyclical sector. So I would caution any investor that is, pounding the table saying commodity is going to go to the moon or something. So I just wanted to show that chart to show the long-term perspective within which we should look at that, because it's only barely crossed what fixed income has done over that 30-year period. With that, I'm going to hand over to Kelvin.
Thanks. Hi, good afternoon and welcome to our premises here. I hope you like this. Actually, this is the first time I'm using this auditorium, ironically. You've never been back to the office since the pandemic started. And we moved in, and I moved in here in January 2020, so it was just perfect timing, right? Never had the chance to use it until Endowus said, hey, let's do it in the auditorium. So yeah, fantastic. Okay, so there are a few things that we need to bear in mind this year as we invest. And the first is this chart here. Tomorrow, or tonight, in fact, we will know how much the Federal Reserve is going to hike, right? And we know that they are hiking 50 basis points. That's pretty much priced in. And they will also release details of the quantitative tightening of the balance sheet, or reduction of the balance sheet. The balance sheet size now is 9 trillion. And that was a function of how much they printed in the last 2 years when the pandemic actually broke. So the forecast for the rates to end this year is at 3%. Right now, it's at 0.4%. By the end of tomorrow, it will be at about plus 50 basis points, so closer to 1%. So you can imagine how much the yields will rise, right? If you go up by 50 basis points for 3 hikes in a row, and by the end of this year it's at 3%, obviously that will have an impact on the equities market, on the fixed income market, on all the other asset classes, because that's where we take our direction from. If it costs you more to borrow, then obviously people who borrow will need to be a lot more selective in what they want to borrow and use the money for. Okay, it's as simple as that. Even after the hike, the real rates are still very, very low. They're still negative. So even if we move up to 3% this year, on a historical basis over the last 20 to 25 years, interest rates are still relatively low. Okay, so it's not a fact that there is no money, it's the fact that there is less easy money floating around. Okay, so it's a tightening of the conditions there. But the biggest elephant in the room, in my view, is this picture here. It's the reduction of the balance sheet. Now, this is unprecedented. We've never had this before. In 2017 and 18, the Federal Reserve also did some tightening, but that was what we call passive tightening, because bonds have an expiry date, right? So when the bonds expire, what the Federal Reserve did then was to let it roll off the shelf. So it was a very slow, gradual reduction of the balance sheet, amounted to nothing. Now, when you have a balance sheet size of 9 trillion and you have core inflation at 6%, you obviously have to actually reduce this and suck out some liquidity there. So this is what they're actually doing. So the pace of the normalization, how much they want to reduce the balance sheet is key. So the market has basically priced in a reduction of around 100 to 125 billion, based on the fact that the Federal Reserve has a soft target of 6 trillion by the end of 2024. So if you do your math, you got half a year left, 2.5 years, from 9 trillion to 6 trillion, it's roughly around 100 to 125 billion, right, a month. And 75% of that will be in US Treasuries, and 25% of that will be in mortgage-backed securities. So the mortgage-backed securities market has started to actually price that in. If you want to buy a property in the US right now and you take out a 30-year fixed-rate mortgage, it's going to cost you about 5.7%. At the start of this year, it was at roughly about 3.5 to 3.75%. So it's actually gone up quite dramatically, and will probably rise a lot more from here. Now, not only that, there is also the treasury bills, which is the short-term treasuries, right? So the market is basically saying, you know what, they'll probably not quicken the pace of that. They'll probably let it roll off the shelf, and then they'll just sell the 10-year treasuries. But if the Federal Reserve decides to actually sell the 2-year notes as well, then you're going to get a pretty hawkish reaction from the markets tomorrow. Now, the dollar has reacted as a result of this and the previous slide here. So the dollar's strength this year has largely been because of the gap between the use of the US dollar and the rest of the G4 currencies, right? So dollar has strengthened to about 108 against the euro. The sterling is at 124, 125. The Aussie dollar is back down to about 70 because of China. And the Chinese yuan has also actually reacted negatively this year. It's down about 660 because of the fact that China is actually easing cutting rates. The US is actually increasing rates, right? So it's quite a big gap to actually fill. Where the Japanese yen is concerned is at 130, probably going to break 130 because of the fact that the Japanese economy is probably the only economy in the world that has not recovered from the COVID-19 pandemic, right? So they're still struggling. So as a result of that, the Bank of Japan feels that there is no need for them to actually hike, and that in fact, at this rate, a weak yen is actually very good for Japanese exports. So they've decided to let it be. So the gap is actually widening. Now, if the Federal Reserve does what we think they're going to do tonight, you'll probably get some profit taking on the dollar. So you probably see the dollar actually move towards the 110, 111 range, okay, on a short-term basis. There'll be some profit taking on the treasuries as well. You know, the 10 years, 2.975% this morning, probably go down to about 2.8%. But the medium-term trend is for the dollar to strengthen, at least for this year, because the Federal Reserve is very hawkish and they have to hike. You have inflation that's so high, it's impossible not to hike. And last night, there was jobs data coming through, right? So now we have the number of jobs available versus the number of workers or unemployed people, and that's 2 to 1. 2 jobs available for each unemployed American. So that's a lot, right? That's, you know, this gap of 5.3 million jobs is something we've not seen since the 1960s. So in order to slow that down or narrow this gap, the Federal Reserve has to make it expensive for businesses to invest, to buy capex, to expand capex, to hire workers. Then the gap could perhaps actually narrow. But of course, at the other end of the spectrum, we're getting talk about a potential recession coming through, right? Now, in our view, we don't think there will be a recession this year. We think the chances of a recession is higher in the second half of next year. But don't let the R word scare you. Recession is just 2 quarters of negative growth. We're not talking about a financial collapse here, so don't run away with a different idea completely. Right? Whenever I use the word recession, I get very nervous because people run away thinking, Kelvin says it's going to be a collapse. It's not a collapse. It's just 2 quarters of negative growth. Okay, it's not so dramatic in that sense. Okay, so if the Federal Reserve starts to tighten, what's the impact on the stock market? Now, very simple. If you look at this slide here, there are 2 lines, right? The S&P 500 and the Fed's balance sheet. If the Federal Reserve's balance sheet is not at 9 trillion, the S&P 500 would not be anywhere close to where it was today. Okay, today it's at 4,001. Prior to that, it was at 4,005 at the start of this year. Right? So if the Federal Reserve reduces the balance sheet, obviously there will be an impact on the stock market. As simple as that. What is the impact? Let's try to quantify it. So if you look at these 2 bar charts here, what they did was they did a regression analysis, right, using a dummy variable on the S&P 500's returns with earnings growth and with the Fed's balance sheet. So the left chart basically tells you that earnings growth, how much a company generates in earnings on a yearly basis, explained nearly 50% of the market returns pre the global financial crisis, but only 21% of the post-global financial crisis returns, because post-GFC, expansion of the balance sheet, right, printing. On the right-hand side, it's even more telling, right? More than half of the non-earnings driven market cap changes were explained by the Federal Reserve's balance sheet expansion post the GFC. So how much can the market drop? Or is there, where are the numbers likely to be? Now, on a year-to-date basis, I mean, if you look at this here, the US equities market has outperformed the rest of the world for the last 13 years. This year, not including, right? Last 13 years, right? So if you invested $100 at the end of 2007, that would have grown to $385 at the end of last year versus $165 invested elsewhere. Where all things are concerned, there is always a mean reversion, because if there is no mean reversion, our kids will be basically 2 stories high, right? You know what I mean, right? Things have to mean revert. So 75% of US out or underperformance over 10-year cycles tend to reverse the following decade. So now we have the first year of a reversal where that is concerned. And we're coming off, right? If you look at the top left-hand chart, the S&P's year-to-date correction is due to the derating of extremely overvalued names. Names like, for example, Netflix, Grab, Bukalapak, Uber, etc., etc. Those are the tech stocks that's in NASDAQ, right? So NASDAQ's correction has been really, really severe. This year, some of the extremely overvalued stocks on the S&P 500 have come off as well, right? So they've actually come off, and you can see there, the numbers are there. On the 21st of December last year, it was basically trading at about 21.4 times. Now it's come off to about 17.5. The 20-year historical average is at about 14.6. So there's another 15 to 17% to go if we go down to the historical average over the last 20 years. Okay, so that's where the picture is at this point in time. So the gap today is at 16 times, which is at 30 times versus 14 times 12 months forward earnings. Okay, so this is where we are in that sense. Now, the other elephant in the room is China. Now, for the Chinese market to rebound, and the Chinese market is cheap. So whenever you want to invest, right, you got to ask yourself this. And Sam is the obvious expert in the room here, not me. Why do you want to invest in the market? Do you want to invest in the market when the economy is at a peak? when earnings growth are at a peak, when the policymakers are tightening, is that where you want to invest? The answer is obviously no, right? You want to invest where the market is basically at the bottom, earnings growth revision is at the bottom, the economy is starting to actually recover. And on top of that, you want to invest when investors are bearish, because when investors are bearish, the institutions are not crowded in there. The institutions are not overcrowded, right? So the market is actually relatively okay, not too tightly held by a lot of institutions, right? And you want to invest when the valuations are cheap. And on top of that, when policymakers are actually starting to actually ease. So for me, China ticks all these boxes. And for a lot of the brokers out there, they tick all these boxes as well. But the market is not moving for two very key reasons. Firstly, COVID-19. When you pursue a zero COVID policy, right, that is extremely negative for consumption. You know what I mean, right? In the last 2 years, when you got circuit breakers, you couldn't go out, what consumption was there? Right? I know my wife was busy shopping online, like a lot of ladies in this room, right? But other than that, you can't really go out, right? You can't go out for drinks, you can't go out and do anything, right, in that sense. So that's one thing. Consumption is actually affected. Your exports are great because when we're shopping online, what do we buy? I know I bought an iMac, I bought several keyboards, 2 mouse. I don't know why, I only have 2 hands, right? But I actually have 4 mouse now. I bought an iPad. I bought a whole lot of junk, and all that has to be manufactured. And where are all these things manufactured? China, Asia, ex-Japan, right? But now that you can actually go out, are you still going to be at home shopping online? Probably not, right? You're going to go out for dinner, for drinks. You go out for your manicure, pedicure, get your hair done. Jamie's going to go out and get a facial and stuff like that. So the services sector starts to grow in that sense, right, so to speak. But in China, because of zero COVID policy, that is actually not happening. So when will they end the zero COVID policy? Only when the political transition is over. Now, this is a very busy slide. And I've used this many, many times because it took me several weeks to actually come up with this slide. So I'm trying to milk it for all it's worth. So what's going to happen is this part here on the extreme right? That's the executive. So towards the end of this year, in November, there will be a political transition, right? So the National Party Congress will be held. There, they will basically choose so 2,000 people will come together in Beijing, and then they will choose the 300 members of the Central Committee, of which they'll choose 25 members of the Politburo, and from the Politburo, they'll elect 7 standing members of the committee, which will be headed by President Xi Jinping. Okay, so that's where it ends. Before that, it's very unlikely that they'll relax the COVID-19 policy. So that's the thing. So for the Chinese market to rebound, you have to be patient. But you're getting in at very attractive valuations right now. And the key about China is this. The renminbi-denominated assets as a percentage of global portfolios right now is at 2%, right? And we estimate that will increase to 10% by the end of this decade. In that sense. So on a technical basis, you should actually see that actually increasing. In fact, Israel just 3 weeks ago announced that now they have 0% of their assets denominated in the renminbi. They want to actually increase that to 2% over the next 3 months. So the flows are starting to come in, right, for technical reasons. By the end of this decade, China is the biggest economy in the world. You cannot have 0 to 2% allocation to the biggest economy in the world. As simple as that. So with that, I hand it back to Jamie.
Thank you very much, both gentlemen. I should actually add a happy 4th of May. May the 4th be with you. I actually forgot about that. Just for all the Star Wars fans as well. Thank you for both of your very good presentations here. I did want to get back to Sam, and he talked about the zero COVID policy that we have in China. Maybe you could just take that on and to add on to what Kelvin has said.
Yeah, there's not much to add. It is what it is. I don't think that, I agree with Kelvin. It is a really, really important year for China, both politically, socially, and economically. Growth is slowing. That's clear. And Xi Jinping is going to go on an unprecedented move to extend his reign, whatever you want to call it, into a 3rd term, which has been unprecedented in modern China. So this is a critical year for the administration, and they have to manage this very well. And COVID-19 zero tolerance is pretty much Xi Jinping's power move. Correct. And so I don't think they'll back down. I agree. And this political transition is too critical and important for the administration. So with that in mind, what they'll do, as Kelvin has highlighted, I think there is more policy easing that will come. Because they've cut reserve rates a little bit, some lending, they'll probably fiscal pump prime a little bit. But really, there's a lot more that they can do. And the timing is probably more suitable to be done in the middle to the second half of this year, when there is a bit more visibility on the outcome of global markets, Fed's policy direction, and they'll see how the economy fares over the next quarter or two. I think the only other thing I would say is that I agree with Kelvin that China is cheap, but it's obviously always been cheap, is the counter argument that everybody says. But I do feel that the Chinese government did quite well last year in moderating some of the potential growth or exuberance in markets, which existed in developed markets, and the reforms that they embarked on in the real estate sector and the technology sector. I think they probably did it in the right time last year. That was probably the only window in which they could have acted, I guess. And so that sets them up well, and it's lowered expectations quite a lot. And I think global investors in particular have very low expectations on China, saying that these guys don't know what they're doing, they messed up on the regulatory reforms, the timing was bad, fixed income markets are terrible, equities markets are terrible. But that obviously is especially since I'm traditionally a contrarian investor as well, I actually just see that as a potential opportunity. But the timing is very difficult, so I'm not going to pretend that the timing we can get right. But if you're a long-term investor, then obviously the assets in China, both equities and fixed income, just purely from long-term potential valuations and ownership is very under-owned at this moment, could present opportunities. So I'll just stop there.
Kelvin, how would you think about the regulatory climate that we're seeing today? I think some of the questions are also coming through that. I don't think it's just big tech in itself, but I think the political transition weighs heavily on people's minds. So how would investors think about that?
I think most of the regulatory developments on the tech side is actually more or less over. What you get in the future is basically fine-tuning of some of the measures, but not a complete overhaul of what you had, like last year, like what we did with the after-school tutoring sector, right, the tuition industry. About 6 weeks ago, they started to issue mobile gaming licenses again. So that's a very clear signal in that sense. Then Premier Li Keqiang has also on 2 occasions basically said that, that stability is actually important going forward, economic, political, and social stability. On top of that, the Made in China 2025 strategy is pretty much still very much alive, right? And you can't achieve that if you keep moving at that kind of speed against the technological sector. A lot of the moves that they made last year was to rein in some of the over-exuberance, as Sam has actually said, in the tech sector, and some of these guys were basically like cowboys. And there was no bigger cowboy than Ant Financial back before they were actually held back, because some of the things they were doing was pretty much not allowed in whether it's in the US, Singapore, or in Europe, right? So that's why they actually step in, because if they didn't step in then, it would have built into a huge bubble, a huge systemic problem, 3 to 5 years down the road. And then after that, it's too late. It's too far gone to actually be able to hold it back. So I think that was actually quite a solid move in that sense from a medium to longer term perspective. And it shouldn't come as a surprise, because 1 year before they derailed the IPO, they already published a draft document and what they wanted to do to actually curb some of the excesses there. So it shouldn't be a huge surprise to a lot of these guys there. So that was actually necessary in my view. So I think most of it is over. Obviously, there's always fine-tuning measures. The only negative, I can't even say it's a negative. The only thing about investing in the Chinese stock market is the stock market is not a priority for the government, not in the way the stock market is a priority for the US Federal Reserve. And it's very, very clear, because only 12 to 15% of Chinese households are invested in the stock market. Whereas in the US, pretty much almost all your pension funds are included or are invested in the stock market because of the tax system itself, right? Because if you buy a stock, you hold it long enough, your capital gains are not taxed. So that explains share buybacks in the US, et cetera, et cetera. So the wealth effect of the US economies, of the US stock market is extremely important. Your property prices rise, your stock markets do well, you feel wealthy, you shop, you buy, right? And Americans love shopping, right? And that fuels the economy, because 70 to 75% of the US economy is basically consumption. So that's why the US stock market is important to the US. But in China, not quite, because again, most of the households are not invested at this point in time. But of course, if the economy is stable, the currency is stable, then obviously the stock market will likely be stable as well in that sense. But they will not go up to actually stabilize it at the expense of anything else in that sense. Don't forget that the Chinese also have a longer term investment horizon, longer term strategy. They tend to plan 15, 20 years ahead, right? At least 5 years. We had the 14th 5-year plan just 2 years ago, right? So they're not on a ad hoc basis reactive in that sense. So in order to achieve the longer term plans, they are willing to actually, perhaps take a back seat to the stock market or to any of the other asset classes. So that's, I think, the main difference between the US and China in that sense.
The way I would actually phrase it is, in China, ideology trumps markets. In the US, markets trump policy, right? So I really do believe the Xi Jinping administration has changed how they manage the economy and society. And so ideology actually is a big driver of even policy and where markets are headed.
There's actually a question online about the common prosperity promise and whether that makes China uninvestable. I mean, how would you think about that?
Okay. Do you want to go first, Kelvin?
Sure. Okay. Yeah. I was teaching with Ray Dalio a couple of weeks ago at the Wealth Management Institute, right? And he basically just published this book called The Changing World Order. And he told me over lunch that for those of you who know Ray Dalio, he's the founder and co-CIO of the world's biggest hedge fund. And he told me that there's only 2 principles in life that he adheres to. 1, don't spend more than you earn. And 2, treat other people well. And then everything will be okay, right? If you look at China and the US, right? The US is spending more than they earn, and then they don't treat each other well. That's why you have these problems in the US right now, right? With all with the polarization between the rich and the average middle class, between the Democrats and the Republicans, and by the end of next month, between those who are pro-abortion and those who are anti-abortion, right? And that's why you get all these cracks appearing there. Now, in the Chinese system, they are definitely earning a lot more than they are spending. They have 3.2 trillion in FX reserves. And on top of that, the common prosperity is all about treating each other well. To them, it's about reducing the Gini coefficient. You don't want the gap to be too big. Because when the gap is too big, you have a lot of issues coming through. Then you get all these popularist moves coming through. You have all this disgruntled people coming through. You get all these protests and all this unhappiness that's just going to result in a very unstable regime in that sense. So common prosperity is all about that, right? So last year, incredibly, China no longer has anyone living below the poverty line, as defined by the World Bank, right? But the gap between the rich and the poor is still very, very wide. Okay, it's extremely wide. You just have to look at the gap between Beijing, Shanghai, and the rest of China, where the provinces are concerned, in terms of the GDP per capita, and you know what I mean, right? Most of the rich people who come to Singapore to buy properties, they're not from Kunming or from Chongqing or from one of those provinces, right? So he's trying to reduce that because the strength and the legitimacy of the Chinese Communist Party comes from the countryside, not from the proletariat. Very different from the Soviet Union, right? So if you want to be able to carry on ruling, then obviously you need to actually look after the entire country and not just the city or the urban dwellers. So that's the policy there. And I think that is what common prosperity is trying to do. It is not about being a Robin Hood, robbing the rich to give to the poor. It's about making sure that the average man on the street is also equally wealthy or wealthy enough to enjoy whatever the country has in terms of its prosperity. And I think they've done that pretty well in that sense, and there's more to come. I can go on about that for quite some time, right? I mean, you just have to look at the drug addiction rates in the US amongst the white Anglo-Saxon Americans who do not have a high school diploma. You know what I mean, right? The drug addiction rates, the alcoholism rates, the suicide rates amongst that class, and you see where the cracks are at this point in time. So.
I knew you had a prepared answer. So. But the only thing I would add is that China has achieved something that no other nation in the history of mankind has achieved, taking 1 billion people out of poverty and creating a massive middle class. So common prosperity is really about China's future and its survival as a nation. And so it's not just purely political, it's not purely about ideology, it's about actual economic sense, right? Building a strong middle class is how US came to be the global powerhouse. And so it's really about that. And I think there's a lot of things that they needed to fix. Inequality obviously is front and center and what shows up. But there is a lot of structural problems in the Chinese economy and the way they've built growth at such a rapid pace, really fueled by debt, right? And so there's structural problems that they need to reform and improve. And I think that adjustment period is what they're going through. And during that time, I think, maybe from a very skeptical perspective, having a much stronger leadership that controls every aspect of their lives, driving the common kind of good, it works. So I think, largely Xi Jinping's, approval rate, especially in city areas, it is extremely high. And so I think there's legitimacy in what they're doing. I think from an economic perspective, it does make sense as well to strengthen the middle class and remove the inequality. So I don't think going back to the original question, is it incompatible? I don't think it is, because US has shown that a strong middle class actually drives markets over the long term.
I'd like to open the time now to the floor. If anyone has any questions, we have roving mics. If anyone has any questions, please raise your... There we go. This gentleman on the third row.
Oh, mic's
ready.
Okay.
Hello, my name's Mark Phibbs. I'm an Endowus customer. Thank you for today. My question is, what opportunities do you both see in terms of the decarbonising of the world economy? Because that's going to be a huge trend, probably being accelerated with the war in Ukraine at the moment.
Do you mean generally or specific to China and emerging markets?
Generally.
Generally, okay. Maybe I can talk generally. I know you talk about it a lot related to China as well, right? So, yeah, no, I think it's critical. That's one of the reasons why Endowus has developed an ESG sustainable portfolio. It's something that really is not, it's still early in its development, and it's a nascent, industry. There's a lot of greenwashing and people not doing it in the right way, and we'll hopefully do our part to improve the investable opportunities out there. But generally, I think, the long-term trends are, we're behind it. Decarbonization is a must for society and in the environment. Yeah. Absolutely.
It's like, if you look at the last 4 decades, right? Every decade there is a major trend. In the 70s it was all about oil prices, right? So the oil majors were the ones that benefited. In the 80s, it was all about the Japanese consumer electronics, right? I mean, looking at some of you in this room, you probably have had a Sony Walkman before, or several, right? That was in the 80s. In the 90s, it was all about basically the telecoms companies, right? With the advent of the handphone or the mobile phone. In the 2000 era, it was all about the social media companies, right? The Facebooks, et cetera, et cetera. Then in 2010s, again, it was basically in the 2000 era, it's all about the shipping companies, the oil companies. Then when the bubble burst, it shifted to the social media companies in the 2010s era, right? Like Tencent's, Alibaba's, Facebook's, et cetera. So if you ask me what's going to be the next big thing, it is certainly the ESG movement. And that's not just for 10 years. I think it's for a long time, because the damage to the environment is huge, right? We can all feel it, we can all see it. And I think that's an irreversible trend. So for me, that's a very important part of it, because I think in the next 5 years, if your company is not green certified, you probably find it difficult. You probably find it very difficult to issue bonds. You'll probably find it very difficult to get loans from the banks. And if you want to issue shares, you do an IPO, it's going to cost you a lot more. When Saudi Aramco listed about 3 to 4 years ago, the kind of cornerstone investors that were in it were none of the big pension funds, because they all made it very clear, including Temasek, right? If you're not green, I'm not going to invest in you. And that's a trend that is totally irreversible. So I think we do think that that you need to actually build sustainable investments as part of your portfolio in that sense. It's completely irreversible, and as Sam has said, it's right at its infancy stage. You're getting in very early at this point.
Hi, I'm Ming Tak. Thank you for sharing your views on China. One question. Looking forward, what are the risks that you see with regards to geopolitics in China. There is actually quite a concerted effort out there to, in some ways, decouple China from, the rest of the global economy, trade sanctions, etc. So, do we see risk from that inside what is a relatively bullish scenario, actually, that we've shared this afternoon?
Geopolitics is fundamentally, when I look at markets, I think long-term geopolitics is normally a bump rather than a fundamental shift in, market direction. So, I don't look at geopolitics as a major factor in looking at long-term markets investments. So that's the first premise that I would start with. But having said that, obviously, especially this year of all years, it's been a massive, impact, both economically and to markets, And it was especially, some people told me it's the first time a foreign nation has invaded a sovereign state in Europe since Hitler, invaded the Eastern European nations. So it really is unprecedented, and most of all, it was unexpected, and that's why I think the financial markets took such a hit. And it involved two nations, Russia and Ukraine, who are neighbors, but also such a critical part of global production of especially essential inputs like oil, gas, soft commodities, food, etc. So I think the nature of this year's geopolitical event has been unprecedented. Last year, China was kind of the culprit, and US trade wars the year before that. So China has been front and center, but this year is not so much. And at the margin, I would suspect that China becomes probably less relevant because I think at the margin, the US-China relationship probably is at a point where it cannot deteriorate further. And at the margin, in fact, the technology stocks may actually survive US listings, and US trade war, at the margin is not getting worse. If anything, it may improve in the future. So I don't think that anything will actually deteriorate further from here. And when you look at markets, I always like to think about things from the change at the margin, so the delta. So it's not the fact that things are bad that causes markets to go down. That's already been priced in normally because markets are efficient. It's the change at the margin, the delta, that drives the incremental market movements. So if we know the Fed is increasing rates to 3% by the end of this year, the market's already priced it in. Market yields at 2 years and 10 years, both with a flat yield curve, is at 3% because we don't know what will happen after that. Equities, likewise, China, all the concerns in the tech sector has been priced in. So if you think about, not just a pure absolute geopolitics is going to get worse or better, what's going to actually drive markets, I don't see too many things related to China that's going to deteriorate meaningfully from here.
Yeah, I agree. In fact, I think a byproduct of this Russia-Ukraine crisis, the fact that, I think most of the Taiwanese sitting there would be, what, let's not provoke the Chinese too much and, let's not bait them. Because, the US is not going to send troops and help out, if that's the case, right? So to speak. And I don't think they are actually, I don't think both sides want to start a war in the first place. There's just too much to lose. There's not going to be any winners, right? There's just going to be massive destruction everywhere. So I don't think they'll do that. But what you could perhaps get is a decoupling of both systems, right? In the sense that, you probably have to get like different, and this where this decoupling is concerned, it's already started, right? I mean, if you go to the US, you use WhatsApp. You go to China, you use WeChat, right? And that kind of thing, right? Not in the other sense of the word, because the Chinese are far too integrated into the global economy for them to be decoupled, right? Decoupling, if you want to decouple China, you can, but that causes a lot more damage to your own economy than anything else. Because you can't just say, overnight, let's make all the iPhones in the US, because you can't. Apple will basically have to shift all the suppliers back there, right? Your Foxconn, Honhai, everybody will have to shift. And then where are you going to get the workers from, right? Where are you going to get all your technicians, your engineers, and all that from? It's very, very difficult. So you can't. So this is not like the Cold War in the 80s where the Soviet Union and the US was fighting on a separate ground. There was very clear differentiation between the Warsaw Pact and the NATO side, because the Soviet Union was not actually integrated into the global economy at that point. China is not just integrated; it is the world's second biggest economy, and it's going to be the world's biggest economy by the end of this decade. So you can't just decouple it in that sense. So yeah, there'll be some, at the margin, there'll be some differentiation, but you can't separate them and cause a conflict of that kind of level. Yeah.
Just one more question.
Hi. Thanks for all the advice, right? So I believe quite a few, or rather many people are already pretty much deeply invested in Chinese markets already. Given the kind of changes that we are seeing with, like tonight and then the April sell-off, what kind of adjustments should people generally think about in terms of their portfolio? Is it equities, is it fixed income, and what kind of things should we pay attention more to in terms of the Chinese market? I think this would be pretty important, right?
Yeah, absolutely. From an Endowus perspective, I think what we espouse is a very passive, strategic way of asset allocation and investing. So our core products, especially on the flagship portfolios, have an allocation to China that is relevant. And I think in a long-term perspective, the weighting will go up naturally because of the growth and more listings of companies in the index. So, China will just be a bigger piece of especially the fixed income market, equities as well. So I think you have exposure. If you do want to gain further exposure in China, then obviously we have portfolios that are dedicated to gaining exposure to China in the satellite positions. But I think from a tactical, investment perspective, which is what I think you're asking, I think Kelvin is much better suited to answer.
Okay, so if you have a lot of Chinese stocks in your portfolios and they're down, what do you do with it, right? You go in there, you look through every single one of them and ask yourself, is it really necessary for me to have this? When the whole market comes off, there are opportunities, right? The worst situation is when the stocks you buy come off and the whole market is up there, then you're stuck. But when the whole market is down, you look through, and if all these stocks are like not worth having, you sell it. You don't hold on to it and hope for it to recover. Sell it and switch it to the index components, because when the whole market recovers, index components will recover. So obviously now there's a very clear chance to do that, because if you have TAL, Education, New Oriental and all that, right, forget it. It's never ever going to come back, right? I get some stubborn old folks telling me, it's going to come back up. Young man, you don't know what you're doing. In 5 years, it will be worth more than it is. Forget it. It's not investable. Not just
old, Kelvin.
Oh, not just old. Yeah,
I've seen young
as well.
people do
Absolutely,
the same thing.
Yeah, sorry about that. So don't be stubborn, right? Cut your losses there and switch, because now you can. If the whole market recovers and you're still stuck there, then you will be kicking yourself, then you can't do it anymore. So I think that's the first thing you need to do. Then after that, I think you need to diversify within China itself, right? So you can have some of the consumer plays, some of the tech plays, some of the value plays as well, and don't be just entirely focused on one particular sector. And I think that's what a lot of retail investors did in the last few years, right? They were just basically looking at Tencent, Alibaba, maybe JD, maybe Baidu a little bit. Then when Kuaishou came to the market, they all went crazy. There's so much more to it, right? I mean, China has the second biggest stock market in the world. What are you talking about? Why are we talking about 10 stocks when it's the second biggest stock market in the world, okay? So make sure you have that exposure, diversify it via funds, via trackers, via the Endowus portfolios as well. And then I think in the next 10 years, you should be fine, really, seriously. So the key is look for returns that are good, and not just good, but different as well. And then you'll be okay in that sense.
One other thing I would add, though, when you're looking at the China market and how it's different from the US market, US actually, most of the companies, the biggest companies, are completely free-floating, as we say. Almost all of the shares, there's no actual owner of the company. It's all listed in the stock market. And therefore, you have a proper representation of the true value and market cap of the company. Whereas in China, a lot of the companies are state-owned enterprises or have massive ownerships, and the actual listing is not really representative of the overall market value of the company. And therefore, and the traditional history of China, having been a communist country, and many of the largest organizations and companies listed there are state-owned banks and financial institutions, or et cetera. There is a difference in the way you approach the market, because I think in the US there's a natural, mechanism through which you sieve out the best companies, and the best companies rise to the cream rises to the top. Whereas China is not necessarily the fact. So there is an element of needing a bit more of an active maybe management style, understanding the market's local kind of flavors and different dynamics. And that's what a lot of, that's why we partner with some of the leading fund managers and UBS too, to find the best kind of managers of Chinese equities. And China obviously is an alphabet soup. It has a A share market, B share market, H share market, red chips, and everything, overseas listings. So it's also a very difficult market to navigate, multiple markets in Shanghai, Shenzhen, etc. So I think there is some value to be had by leveraging professional investors who actually do that well. And there have been great investors who've been able to outperform in China over a period of time. And that's why in satellite portfolios, it's actually good to have some active management input as well.
I like how Kelvin stomped his feet when he talked about top managers. In other
Unintentionally.
words, no power to him. We're actually a little bit out of time, unfortunately, but we're going to end this session officially. Thank you very much for the online audience that is with us here today. Thank you for all your questions that are here as well. We will end the session, but the people who are, of course, still in the audience, please feel free to come forward. I won't say mob them, but please come forward politely.
So we do
If
one
you
more
have-
question since
if
he
you-
raised his hand. One last question.
Would you like? Okay, we
Yeah.
could have.
Yeah, one
maybe-
last.
Okay, we could have 2 questions.
Yeah.
Hi, thank you. Given the positive things you said about the flows into China and where the Chinese people have most of their wealth, does it make sense to, what is your opinion on the risk rewards of buying, say, fixed income in Chinese real estate companies?
Oh, okay. Very
Okay.
specific question.
Yeah. It depends on what your risk appetite is, right? So, if you look at the government's labeling of the Chinese property developers, there's the green label, orange, red, and yellow, right? Obviously, stay away from the red and the orange for very obvious reasons. The risk reward with the green label is extremely high. I would sell my mother-in-law to put money in there because the risk reward is fantastic. And you don't have to go long term, right? You don't have to go long tenure. You can just go very short tenure, 2 years maximum, and you'll be rewarded. Because I think the market has actually stabilized. The year-on-year sales volumes in China for April was down about 56%. And that's because last year in April, we had a pretty high sales volume. So this year, because of the lockdowns, people can't go out, they can't buy, right? Most people would not buy a property unless they've seen it or at least visited the show flat. You're not just going to buy a property online when you want to buy something like that. So the property market sales volumes will only recover when the lockdowns end and people can start going out again. But the prices have not fallen dramatically. The prices have actually held really well. And what's more important is that there is no inventory overhang. Now, the key about the Chinese market is that when you buy a property, you pay up front, but all that money doesn't go to a developer. So assuming I buy a property, right, and Sam is the developer, right, I pay him, but the money is not gone to him. The money is actually held with a bank in escrow by Jamie, Bank Jamie. So if Sam, absconds with my money, he runs away, right? He doesn't want to build it. I get money back from Jamie itself, right? But if Sam is a very good developer, he has a problem. Because then he has to borrow, he has to issue bonds to get the capital to build what I've actually bought, right? In that sense. But now that there is a liquidity squeeze in China, even though he previously could issue at 4%, he has to issue at 6% right now. And previously, the issue size could be 100 million. He is now stuck. He can only issue 50 million because you guys are also negative on the market. So there is a squeeze going through, and it is consolidation happening in the market at this point in time. So which, in other words, means don't go for the other labels. Just stay with the green labels, short tenor. The risk reward is fantastic. Yeah. I would say in US dollar. Yeah, in US dollar. Yeah. It's quite liquid. If you want to do RMB, you can, but then you have to look at the CNH market, no longer the CNY market. Yeah. Okay.
Do you want to take that?
No.
question?
I was just going to say the only problem is the FX risk.
Yeah, correct, yeah.
Since the yield differential between Chinese yuan and US dollar has actually reversed. So whereas China had a much higher interest rate and US was at 0, effectively it's actually gone the other way, where US is actually 50 beeps higher. So the recent Chinese yuan, depreciation has been like a very rapid market reaction to that. So that's the only risk I would, suggest exists. So look at that. But Kelvin gave a great answer. Yeah.
So go for the dollar or the Hong Kong denominated.
Yep.
I think the yuan, now that you brought it up, great point. The yuan was playing catch up because last year the yuan actually gained about 12 to 15% on trade-weighted basis.
Yep.
And I think there is a limit as to how much the yuan can actually go down to, because if it goes down too much, then you get this imported inflation problem coming in, because China is a net commodities importer in that sense. So they will probably want to control that to a certain extent. But be aware of the FX risk in that sense.
Thank you very much for your questions. Please continue to ask questions for those who are already in the audience. And again, thank you for joining us online as well. For those of you who are also in the audience, we will have a room set aside, for example, for a demo experience if you have. Of course, if you have other questions, the wonderful CX team is also on here to meet all of you. I understand some of you have not actually met some of them face to face, so this might be a wonderful time to actually just meet. So we've set aside some time for mingling as well. But if you have other questions, please come forward, and the two gentlemen will be here to answer all of them. Thank you very much for being with us today. Thank you very much.